All right, so we have a few things to do today. We're going to start with the Chapter 10 problem set. All right, and then when we're done with this, we can get back into Chapter 15. So what is the difference between GNP and GDP? Well, GDP measures the output of final goods and services produced within the borders of a country during a given year. GNP, on the other hand, measures the output of final goods and services produced by the citizens of a country during a given year. That's what really separates the two. It's not about what's being produced, but in one case it's where. That would be this first one. GDP is focused on where the output is being produced, and GNP is focused on who produced it. Okay, so they're both equally valid measures of national income or national output. But for many decades, GNP was the preferred measure. But I think now most economists seem to think that GDP is the better measure. So, it's really kind of a matter of opinion because they both have advantages and disadvantages. Now, would cars produced by Nissan in the United States be included in Japan's GNP? The answer is yes, because the cars are being produced by a Japanese company, in spite of the fact that the cars are being produced in the United States. In other words, as far as GNP is concerned, all that's relevant is that the cars are being made by a Japanese company. On the other hand, how about Ford cars being produced in the UK? This is a no, because the cars are not being produced in the United States. Okay, so with GDP, remember, it's the location that really matters. It doesn't matter that it's an American company. The fact that the cars are being produced in England means that they're not getting counted in the United States GDP. All right, what are the four components of GDP? All right, we have consumer spending, investment spending, government spending, and net exports. All right, remember this one is labeled as C, I, G, and net exports. How long are durable goods intended to last? That would be 3 years or more. Wire transfer payments not included in the calculation of GDP. This ensures that the transfer payments are not counted twice in the calculation of GDP. In other words, as an example, and this is not necessary for you, but as an example, if Social Security checks are sent to recipients who then spend the money on final goods and services, GDP would only count the purchase of the final goods and services, not the transfer payments. If they did, otherwise, these funds would be counted twice. Okay, so in other words, it's just a way of making sure that we do not accidentally include both the money that was sent out to these people, but also what they spent it on. All right, so now the only component of GDP that can be negative is net exports. And that's because, of course, this will be negative if imports exceed exports. What are the four sections of the balance of payments? All right, so remember, it's the current account, capital account, financial account, and our old friend, the statistical discrepancy, which is there just to balance it out, okay? Because we know that perfectly well that the information is not perfect, and so we need something to account for that. All right, net exports appear on which section of the balance of payments? That would be the current account balance. Okay, so in other words, yeah, the trade balance is part of the current account balance. Net income receipts, these are cash inflows. Let's see. Let's put it this way. Net income receipts equal the difference between inflows and outflows of income receipts from the United States. Income receipts include. So the four basic categories would be wages from labor, rent from land, interest from capital, and finally profits from entrepreneurship. Okay, so obviously these flows go both directions, out of the country and into the country. The net income receipt means the difference between the two. And this one can be negative, by the way. So if more money is coming in than going out, we have positive net income receipts. If more money goes out than in, we have negative net income receipts. But any way you look at it, it's really the difference between what is coming in and what's going out from these four basic sources. Foreign direct investment means that this occurs when U.S. companies and individuals invest in foreign real assets, such as real estate, buying businesses, setting up businesses, so for example, if Starbucks opens a new store in Paris, this would be an example of U.S. foreign direct investment. Because they're not buying stocks and bonds, they're buying physical goods and services. Well, physical goods, I should say. In other words, the actual store itself is the direct investment. All right, now, the official reserve accounts it can include several different types of assets, among which is gold, although that's a fairly small percentage. Why don't we go back here and look at the list? And these are relatively small amounts. U.S. official reserve assets would be gold and foreign assets, which typically means such as foreign bonds. and foreign bank accounts. If these belong to the government or any government agency, they're considered to be U.S. official reserve assets. The other components of the balance of payments are owned by private individuals or private companies. These are official government assets. Okay, often they're held by either the Fed or maybe a government agency. And then the financial account balance is really broken up into three main components. Let's go back. Yeah, here it is. And a lot of it, well, first of all, it's U.S. assets held abroad, which means we buy assets in foreign countries. And you notice how it says net of financial derivatives. Financial derivatives are a very different matter altogether. These are financial assets, but they're very different kind of financial assets. Their value depends on some underlying security, and their values are very volatile. So the government, when they put together the balance of payments, they're trying to keep their focus on actual physical assets or financial assets. Derivatives are held in a separate category because, like I said, their value is very volatile, and because it ultimately depends on underlying assets such as stocks and bonds or possibly real estate. Then we also have foreign-owned, well, the reverse direction. There's foreign-owned assets in the U.S. Again, net of financial derivatives. Okay. And then finally, we have the financial derivatives. They're listed separately. Net financial derivatives, because we want to know the difference between which ones belong to Americans and which ones belong to foreigners. The sum of the current account, capital account, financial account, and statistical discrepancy always adds up to zero. That's done by definition or by design. In fact, the statistical discrepancy is just there to make sure that this happens. It's like a fudge factor. All right. Now, what if the dollar appreciates? What is the impact on the current account balance? Well, this will cause exports to decline and imports to rise so that the current account balance worsens. Okay, so so that's it for this. I'm going to have problem sets, of course, for the later chapters as well. But for now, this will do as a starting point, because remember, this is the start of the new material. And so I'll post these on Moodle later on. And then right now, we're going to go back and revisit our discussion about Chapter 15, which looks at different historical financial systems, include exchange rate regimes that we've seen since really the beginning of the, well, even I guess before the beginning of the 20th century. But we want to focus on exchange rate regimes that have been in place in recent history, just to see how they differ from what we have now and how they impact on the economy. All right, so this is Chapter 15. And remember, we are skipping over 14 because, of course, we're running a little low on time here. So last time, we briefly looked at the gold standard, and we've already seen videos about the gold standard, which were pretty interesting. But then we were focusing on Bretton Woods, which, of course, no longer exists. This was a system where the dollar was tied to gold at a rate of, believe it or not, $35 an ounce. It's hard to imagine now. Now, this was many years ago, of course, but still, right now we're looking at $1,700 an ounce. So that's a big increase, okay, and a lot more than inflation can account for. But keep in mind, too, gold is seen as a safe haven by investors. And so when things are tough, people will tend to buy more gold and sell off more traditional assets like stocks, so that gold prices tend to benefit from a lousy economy. And so like right now, with all the uncertainty over COVID, you would expect gold to certainly benefit from that. But at this point in time, the U.S. owned most of the world's gold. And so it made sense that we would hold the gold and we would offer to exchange dollars for gold at any time, and at a rate of $35 an ounce. And then all the other countries had their currencies tied to the dollar, so that we had a system of fixed exchange rates, which was designed to get rid of foreign exchange risk. And there was hope that that would help establish or reestablish trade relationships between the United States and the rest of the world, the ones that were destroyed by World War II. And it did work for a while. It worked quite well, as a matter of fact, but eventually it became clear that it had outlived its usefulness. And there we go. We had to get rid of it in 1971 because we were losing all of our gold because we kept having massive trade deficits. So as part of this plan, we established the IMF, which even to this day provides funding to countries that need it, as well as the World Bank, which does basically the same thing, only it focuses on smaller third world countries. Bretton Woods fell apart in the early 70s, and once it was gone, it was replaced by what we have now, which is floating exchange rates. Okay, they're not set by the Fed. The Fed has really nothing to do with exchange rates. They're determined in free markets by the forces of supply and demand. Anyhow, we did see that there are several different kinds of exchange rate systems that have been used in recent history. And we started to look at a couple of these. In fact, we started to look at dollarization, which is part of this first category, exchange arrangements with no separate legal tender. And all that means is that the domestic country has no currency of its own. It's using a foreign currency, which is almost always the dollar. For a while there, when the euro was first created, it appeared that a lot of countries are interested in using the euro as their own currency, but it never actually happened. In fact, the Eurozone itself, the European Central Bank, had the attitude that they really would prefer that countries not do this, whereas the Fed has no problem with it. So dollarization makes sense for a lot of countries, especially if they do a lot of their trade with the United States. All right. So the other ones we'll be looking at here, you can see currency boards. That's a very interesting arrangement, which we'll discuss, that was used by Argentina for many years, although they eventually had to give it up. We have other fixed peg arrangements. We have these others where they can fluctuate within horizontal bands. We have crawling pegs, which we'll be looking at more closely today. Exchange rates within crawling pegs. And then finally, managed float and independent float. Managed float means that we have flexible exchange rates where the central bank still reserves the right to intervene in foreign exchange markets. Independent float means that it's completely independent. The central bank never intervenes. All right, so we've already talked about Ecuadorian dollarization. We also briefly talked about Venezuela. And in fact, I did find another good video about Venezuela that I'd like us to look at. And then what we're also going to look at is the euro, because of course you probably know that the euro combines 19 countries who use one currency. They all gave up their own currencies to join this European monetary union. And as a result, they all now use the euro as their own currency. They've given up their own currencies. So that would be another example of what we mean by exchange arrangements with no separate legal tender. All right, so why don't we do this? Why don't we check out this video, this second video about the Venezuelan situation, which, as you know, is very, very dire. The country's in really a lot of trouble. So let me grab this for you. Let me put this away. And let's get the video going. It's called The Plummeting Bolivar. And I think that says everything that you need to know. All right, so let's check this out.
Hi, we're in the space market. We rescue
All right, so that's done. So you can see, yes, they're in mighty big trouble in Argentina. I mean, sorry, Venezuela. And yes, of course, anytime that happens, almost without fail, people stop accepting the local currency and start using a strong currency like the dollar. Now, technically, that's illegal in countries like Venezuela because they have a very strong dictatorial government, and they recognize that this is a threat to their power. But it goes on everywhere, so they can't realistically arrest everyone. So it's fairly common to have black markets in currencies in countries where the economy is in such terrible shape. And that happens a lot in Cuba as well. Cuba being a communist country, of course, that means that they're always in trouble financially, and so people survive by using dollars instead of the local currency, the peso. So that in that sense, this is not unusual. But you can see the problem with it, though. Like they were saying in the video, a lot of people are getting squeezed because their salaries are in bolivars, which rapidly become worthless, and yet a lot of their expenses are in dollars. So it's a tough time for the people of Venezuela. And so, but of course, one of the natural consequences of that is that they turn to dollars instead of their own currency, which is essentially worthless. And of course, if you travel in the Caribbean, you're going to find that a lot of those countries, while they don't actually have a dollar standard, they have their own currencies, but a lot of transactions are made in dollars. A lot of the stores use dollars, and in fact, they would rather have dollars than their own currency. And also, I mean, that really is a sign that the economies are struggling when they would rather have a foreign currency than their own. So it's not that unusual, but it's reached an extreme case in Venezuela because the currency is basically collapsing. Now, one of the other types of exchange rate systems we saw on our list, let's go back and look at the notes for a second. What happened here? Here it is. So if you look at the list of exchange rate regimes that are recognized by the IMF, you saw in that list, here we are. We've got exchange rate arrangements. So again, this would include dollarization and monetary unions like the euro, which we'll be discussing in a bit. But if you also look here, we have this other item here called currency boards. So what exactly is a currency board? Well, let me just write this out on a separate document. With a currency board, the central bank offers to exchange a fixed number of dollars for the local currency at any time. So, for example, in Argentina in the 1990s, the Central Bank of Argentina set up a currency board which offered to exchange $1 for every peso that our citizens brought to the central bank. In other words, they're basically saying, listen, don't worry about the currency. The peso is not exactly backed by the dollar, but if you're worried about the strength of the peso, we'll give you $1 for every peso that you bring to us. So there's an implicit guarantee there that the Argentine peso will stay as strong as the US dollar. Now, in order to keep the system running, the central bank held $1 in its reserves for every peso in circulation, just to make sure that they didn't run out. So this is where it's different than dollarization. With dollarization, if they'd gone with dollarization, they would have just said, listen, everyone, we're getting rid of the peso. From now on, we only use dollars here. But instead, they kept the peso, but with the understanding that anytime anybody wanted to, they could trade their pesos for dollars at a rate of 1-to-1. So now the good thing about this, like with dollarization, this means that Argentina's interest rates and inflation would fall back to levels much closer than to the US dollar, sorry. Okay, so they had experienced, now Argentina unfortunately has a long history of experiencing high inflation and high interest rates. They have a tendency to go through these cycles where all of a sudden you turn around and their unemployment rate is high, their interest rates are high, their inflation rates are high. And they've had years where they had inflation in the thousands of percentage points. This helps bring that back down again to more normal levels. And of course, also in common with dollarization, having a currency board implies a loss of control of monetary policy, because they can't just change, they don't actually have the ability to change the quantity of pesos unless they're able to also simultaneously acquire enough dollars to back them up. So they don't have a whole lot of control over their own money supply. And so that means they're essentially giving up control of monetary policy. And another major issue that Argentina ran into was that the dollar was extremely strong in the 90s. This meant that Argentina's exports would be very expensive. And this meant that they experienced rising trade deficits. Now, that's a problem for Argentina because, like many countries, a majority of their GDP, or a very large percentage of it, is actually coming from trade. And now, not so much the US, but with Argentina and many other countries, a very large percentage of their economy is coming from exports. So if their exports are becoming too expensive, that's a huge deal. And in fact, like, why don't we do this? I think we did this once before. We found a chart on the internet which showed what percentage of GDP derived from trade by a country. All right, so we had, yeah, I think we may have already looked at this. But yeah, here it is. I thought so. Right here in the bottom, far right, we have imports and exports percentage of GDP. So if we look for Argentina, okay, where are you, Argentina? I guess this is the standard throughout most of the world. But so these are the countries that are above the average, and these are the countries that are below the average. Well, here's the US. Now look how low these numbers are. 11.9% of our exports represent about 11.9% of our GDP. Okay, that's not much. I'm still having trouble, though, finding Argentina. I must have gone right past it.
It's right below the United States.
It is? Oh my God. Well, I'll tell you what, at the time, though, in the 90s, it was a very different situation because right now, where is it? Argentina. Oh, there it is. Wow. But that wasn't always true. So I'm a little surprised to see that. But in the 90s, Argentina's GDP was much more heavily dependent on exports than it is now. So having an expensive currency was a real problem. And so another issue that really was a problem for Argentina also had a substantial, and they still do, amount of foreign debt denominated in dollars. Ooh, now that could be a problem, because this meant that their debts with a strong currency let's just say that their debts were growing at an alarming rate, and soon they became unable to finance their deficits. In 2001, Argentina defaulted on its foreign debt. Now, a default means not paying debts back in time. So investors who held Argentinian bonds, let's say, lost substantial amounts of money as a result. And then because of this, Argentina was unable to borrow from foreigners for many years afterwards. So in other words, they were running into trouble for they had this currency board which is designed to reduce their inflation and interest rates, and it worked well in that sense. But then they suddenly found themselves with a very strong currency, which discouraged their exports, and it also increased the value of their foreign debts, and so which were massive, by the way. I mean, really, really large, very to the point where it wasn't a surprise to anyone that they reached a point where they couldn't cover their debts because they really, really borrowed so much money. It was a kind of situation where every year their budget deficits were just massive, and they just couldn't seem to get their spending under control. And so by having all that debt and having a strong currency, they could no longer earn enough money from exports to help pay for their foreign debts. And before you knew it, pow, in 2001, they defaulted. Now, a default with a government is very different than a default for a domestic company. Like if, let's say, Ford defaults on its debt, there are options that they have where they can go into Chapter 11 bankruptcy and renegotiate their debts and hopefully survive and carry on doing business. But with a sovereign government, there really is no such thing as bankruptcy. It's just a question of what do we do now? And what often happens is that they negotiate with the creditors, the bondholders, and offer to pay them a smaller rate of interest spread out over more years. And often the investors have to take that deal because it's better than nothing. So while the owners of these bonds might have eventually gotten their money back, it would have taken a lot longer than it should have, and the rate of interest that they would have gotten would have been lower. So they still would have suffered substantial losses, and they also would have refused to lend any more money to Argentina until they really got their act together. And so part of the problem here was that having such a strong currency caused by this currency board. But, you know, the reality is they'd had so much inflation before that they felt it was worth this experiment to see if they could do something different that didn't involve a lot of inflation. So unfortunately, it all came apart in 2001. Now, you would think that, you know, let's face it, things have changed. And by the way, when this happened, the currency board was abandoned. I almost forgot to mention that detail. After Argentina defaulted on its debt, it also abandoned the currency board. Now, you can see why they were reluctant to do this. Immediately, the peso collapsed. As the exchange rate went from 1 peso per dollar almost immediately to 4 pesos per dollar. Almost overnight. This had the effect of dramatically increasing import prices, including food, of course. And as a result, inflation increased substantially, which is exactly what they're hoping to avoid. All of a sudden, their currency is worth a quarter of what it had previously been. And so you're getting much higher import prices. And you're also, or in oil too, I guess I should have put that in there, oil. And so now suddenly their currency is much weaker and inflation increased substantially. This in turn increased interest rates dramatically and plunged the country into a deep recession. So they were in a lot of trouble. Now the IMF helped them out. They lent them money to help them, and things were going well for a while. But now, unfortunately, about a year or so ago, the same thing happened. They had to default again because they just had too much debt. Although this time they did not have a currency board, other factors contributed to this collapse. And so you do get these countries where, you know, they just keep running into the same problems over and over again. Brazil is another example. They have enormous amounts of foreign debt. Now, unlike an American company, like imagine you own stock in a company in the United States. And like I said, they run into trouble. They can declare bankruptcy and in effect start all over again. A sovereign government cannot declare bankruptcy. They can't just wipe out their debts. All they can really do is hope that they can negotiate better terms with their creditors and eventually pay them all back. So this is why it takes so long for them to recover from something like this. So I found a video. It wasn't directly about the currency board, but it is about the situation in Argentina right now, where their currency is falling like crazy. And so what they're going to do is analyze the factors that cause this to happen. And again, even though this time it's not because of a currency board, a lot of the same factors are responsible for causing the currency to collapse again. So I thought it would be interesting to watch this one as well, even though it's not, like I said, actually about Argentina's currency board. At least it helps us understand what's going on in Argentina. And you might see some parallels with what's going on in Venezuela. Okay, so all right, let me fire this off to you. All right, let's check this out and see what's going on in poor Argentina. All right, so that was interesting. Now, so yeah, but the interesting thing about Argentina, now, unfortunately, I've not been able to locate a good video about their currency board system. I'm not quite sure why. Maybe it isn't that exciting, but ever since they got rid of it, of course, their inflation rate has gone up again. And like you're saying in the video, a lot of their prices are tied to the US dollar. And that's because the merchants in the country won't accept their own currency because they're so worried about its value. So it becomes a real problem, especially when the dollar gets unusually strong. But anyway, so among all the other types of currency arrangements we have listed here, another one that we will definitely spend a lot of time with is the euro, of course, which is really a very exciting system. And in fact, it's unprecedented in history to have such a large collection of countries using the same currency. But it turns out, of course, there are consequences to being a member of the Eurozone that we will look at. In particular, I was thinking in terms of the Greek debt crisis, which very nearly caused them to drop out of the Eurozone. And we'll go through that too. But before we do that, I did find wait a minute, sometime before we looked at the fixed exchange rate between the Hong Kong dollar and the US dollar, I believe. Yes, we did. So what I wanted to do is show you a follow-up video about another alternative possibility that is available and has been widely used by countries, especially the former communist countries, after the fall of the Berlin Wall. They adopted the system called the crawling peg, which is sort of like a hybrid between having a fixed exchange rate and a floating exchange rate. It's kind of like a transition between the two. So I wanted to mention that first. And then fairly soon we'll be going over the euro because we really want to spend a lot of time with that. So in this particular video, we're going to be introduced very briefly to this idea of the crawling peg. Okay, and again, the idea is that it is somewhat like a fixed exchange rate that is being regularly adjusted to take into account how strong the economy happens to be. So let me fire this off to you right now. And let's see what that's all about. All right, well, that was a lot faster than I expected. But yeah, so we'll be discussing that more later on. And anyway, so I have this other video, which is sort of like not really directly related to the others, but it's kind of an interesting story anyway. And so it turns out that the most expensive currency in the world is the Kuwait's currency, whose name I've forgotten already. Let's check this out. Hold on one second. Okay, the Kuwaiti currency is called the dinar, D-I-N-A-R. It takes $3.27 to buy one Kuwaiti dinar. Now, that seems kind of strange. So we're going to watch this video now and try to understand how this happened Why is this Kuwaiti currency so expensive compared to the US dollar? Okay, so let's check this out. All right, so that was kind of cool. Now, while we're talking about exchange rate regimes and especially pegged exchange rates and alternative systems involving currencies' strengths being determined by other currencies, I thought it might be an appropriate moment to briefly look at the Chinese currency and how they maintain their fixed exchange rate. So, which they do have, by the way, like Hong Kong, except that it's not actually tied directly to the dollar. It is tied directly to a basket of currencies, but they still attempt to keep it at a fixed rate in order to stimulate their own exports to the West. Because their strategy, of course, is to grow as fast as they can, based on exporting as much as they can to the West. And so, in order to do that, they've found a way to keep their currency at an artificially weak level compared to where it would be if it were freely floating. Okay, so why don't we check out how this is happening? All right, let's watch this.
Made in China, from low quality disposable toys to high end electronics. The nation has become how this impacts price competition. Over To get $5 RMB for your dollar. The opposite is also true. Nobody is going to society. Go watch our video on black market economics to learn more about that. But in short, it is basically just the cost.
All right, well, I guess we're all done. So, all right, well, you can see it's almost 4 o'clock, so I guess that'll be it for today. So we'll pick it up from here on Monday, and we'll carry on with our discussion about different exchange rate systems. And so I'll see you then.
Thank you. Have a good day.
You're welcome.
All right. Have a
Okay,
good day,
Christian,
everyone.
thank you.
Bye.